just started the video. Hi guys, and let's get started. So first of all, what I do every single day is I look at my scanners and I look at Yahoo Finance to check out the news. So that's what we're gonna do right now. I don't believe they have a PR out right now, but it's always a good thing to check it out because every single news has another reaction basically and other stats. I always trade with stats because it's the only way to have an edge and to trade consistently. So let's check it out. 22 minutes ago, AYTU Bioscience announces Zolimus global distribution agreement. Alright, so let's check it out. First thing, I scroll down and I look at, is the news recycled? So is it the first time that they bring out the news, or did they talk about it before? Because if you just recycle your news, basically talking about exactly the same thing as the last time, it won't have the same effect. And what I'm seeing is that yes, they talked about it before. All right. So let's see here. Oops. 2 months ago, I believe, they talked about nearly the same thing, basically an other agreement, which is pretty nice. So I'm gonna keep that in mind. And after that, I'm gonna look at the stats. All right. Sorry if I pause sometimes because I'm already in a position right now in SSLG. I'm in from the 140 area right now. I added in the 130s, and the plan will be a retest of that 1.1 area. So that's why sometimes I'm kind of stopping. What I'm checking out, so if you basically on Yahoo, you're gonna have the summary tab, chart, conversations, and statistics. I click on the statistics tab and I look at a few things. First of all, I look at the float, alright? I don't want to be in a stock too big short if the float is below 3 million. Everything below 1 million or even below 2 million, I'm going to avoid completely on the short side just because it's far too risky, alright? Chat pumps could come in and so on and so on. I think most of you know why, but I'm going to talk about that too in another video. So I'm looking at the stats and I see, alright, the float is 8.55 million. There are other ways to calculate the float, and we're going to talk about that too. But for this video, we won't. Alright, so I'm going to type in 8.55 million float. So that's another thing that you maybe don't know about me. Few of you have traded with me before. So I've got basically a worksheet where I write down everything, all right? I write down everything about the fundamental research in it for every single stock, all right? I've got a big list basically with all the stocks. So every time a stock pops up, I'm gonna look up the name, and most of the time I will find it there. After, let's say, a year of trading or something, you're gonna have most of the tickers, because most of the tickers come multiple times throughout, let's say, maybe, so AYTU, it's already like the third time that I traded this year, I think, or that I want to trade it this year. UPTH, same thing, and then other tickers that constantly come up, like, let's give you an example, or no, not that one, SLS, for example, comes like every month or like 3 months. Yeah, that's why I have the list basically. So after that, I'm gonna check out the institutional ownership, and in this case, it's 25.64%. So we're gonna write that down too, just because the higher the number, the more manipulated it will be. So you just have to think about it. Institutions don't want to lose money, so every time the stock is gonna gap up or something, they are going to try to hold it up basically, because it's so they basically make money out of it, you know. They won't let it crash easily. So the bigger the number, the worse basically. And in this case, it's 25.6%. It's all right. It's not that big. Everything over 40 to 50%, I'm kind of already like, all right, I'm gonna be defensive about this one, and everything above 70% is gonna be an avoid completely for me. I'm gonna make a special video about the rules or video series, how I manage my risk basically, because this is a part of it. So after that, we're gonna look at the short percentage of float, which means percentage-wise compared to the float, how many shorts are in it. Because the more shorts are in it, the more it will spike if it gaps up. You just have to think about it. You're short from, let's say, an average of $1 or something, and it gaps up to $2. All of a sudden, you're down 100%, and then it continues to run. And then you're just thinking, I need to cover right now because I'm going to lose all my money, basically. So that's why we're looking at it. And in this case, it's 15.46%, which is all right. It's not that big. A lot of people will be in from a higher average, as AYTU gap down from a range of, I think, $5 or something. Or moved down from $5, gap down from $2. So after that, we're going to check out the filings. I don't know how many of you are kind of familiar with them, so I'm just going to talk slowly. So we're going to pull up the website BAM SEC, the float short. Yeah, but it doesn't matter. Like even if it's updated on a monthly basis, it doesn't matter really, because I mean, look at the chart. I'm going to pull it up too. Even if it's updated monthly, like a month ago, what was like in February, you still have the same range. Like it doesn't really matter, and you know that a lot of shorts shorted before. It's not like they shorted yesterday, you know. But it doesn't really matter. Like it's not like, let's say 15% is something else and 16%. Like I'm always looking at the bigger picture here. All right, so let's say under 10%, I'm all good. I don't even look at it. Over 20%, I already think, all right, that could be dangerous. Over 30%, I'm thinking I might avoid this one. And everything over, I'm just thinking, you know what, I'm just going to avoid it completely because the short squeeze potential is just so big. So I pulled up the BAM SEC website. You can do it too with the official SEC website. And I pulled up the last 10Q, so the Q2 from 2019, 10Q posted on the 7th of, what was that? 2nd of February, I believe, yeah. Alright, so then we scroll down and we'll look for part 1, financial. Oh, wait a sec, I got to cover a bit of my SSLG right now. Really nice move. Let me cover 1/3 actually. We try, yeah, thank you. Just because we are right now at that support area that I was talking about just before, so I'm just going to cover a bit. I think I'm going to make a video about that one too, why I shorted it and so on and so on, because it was a pretty nice trade. Like we had some nice volume on that one pre-market that allowed me to really get in that one. All right, I put on an order. I get filled, I think, soon. If not that big of a deal, I'm gonna wait for a bounce and add some more because I do think this one is done now. So we're gonna look at part 1, financial information. All right, and we're gonna look at the current assets. And at the cash they have. So they have 17.8 million cash, so we're going to write that down first. Just copy and paste it. That's how I do it every time. 17.8 million, and I write down cash and then as of, and then you're going to see just above it December 31 2018. So I'm going to write down EOD. All right, that stands for end of December and then 2018. All right. After that, we're going to look at the current assets and the current liabilities. These are just, if you scroll down just a bit, just under it, just under basically the asset tab, total current assets 21.977 million. And I'm not going to write that one down, but I'm going to take out my calculator. All right. Why is that? Because I want to have a ratio. I want to look, it doesn't matter how much assets you have or current assets, same as the cash, if you have basically a lot of liabilities or you just can't make your company work. So that's why we're looking at it. So 21.977, one sec, 21.977,229, and then we're going to divide that by the total current liabilities. So basically the whole other side, so how much assets you have and how much liabilities will make basically the worth of the company. So in this case, we've got 4.655 million. So we're going to divide the number of the total current assets by the total current liabilities. And we're going to find out, all right, 4,655,472 gives us a ratio of 4.7, all right? That means the total current assets, if or total current liabilities, if they have or had to pay back everything, they would still have right around 4 times more. All right. Most of the companies we talk about are not solvent, or a lot of them are not solvent, which means if they have or if they had to pay back everything, they wouldn't have enough cash to do so. All right. So we're gonna write down 4.72 current ratio, and then we're gonna write down also the net working capital. Net working capital has been calculated by the same thing, by the same two numbers, but basically we're not gonna divide them, but subtract them. So we're gonna take 21.977 and then minus where is it here? Minus 4,655, and we're going to get the number 17.322 million NWC, so net working capital. And after that, we're going to look at their accumulated deficit. Just if you scroll down just a bit, under same basically page, you're going to see accumulated deficit. Just look at the first number, so the number that is the newest, which is in this case 87 million. So we're going to write that down or copy and paste it here, million, and then ACC for accumulated deficit. After that, we want to compare how much cash do they actually have. Because as I said previously, it doesn't matter. You can have 1 billion cash, but if your company constantly burns, let's say 500 million per month, you only have 2 months of cash that you can use, all right? So the cash, it doesn't matter how much it is, you always need to compare it to the cash burn. And to do so, you're gonna type basically Control F to find, and you're gonna type in cash flow, all right? And just the second thing you're gonna find, it's called consolidated statements of cash flow. 1 sec, I think I got filled. Yeah, I got filled 1/3. All right, holding the rest. You're gonna find the cash flow statements. All right, and you're gonna look at basically the first kind of column that they have, and you're gonna look at net cash used in operating activities. You can also, instead of type in cash flow, type in net cash used in or net cash blah blah. But sometimes it's written in another fashion with kind of brackets or something, so that's why I like to do it that way. And you're going to see that the cash burn is, or the cash used in the operating activities, is 7.047 million. All right, and then you look up and you're gonna search for the period. The period is in this case 6 months. I just if you look just up a bit, 6 months, and now you're gonna basically calculate the cash burn, and you do so by taking the 7 million we just talked about, so 7.047, and you're gonna divide that by 6, by the period basically in which they burned the cash, and you're gonna find out that their cash burn is 1.174 million dollars per month burn. So you write that down too. And now you compare it, all right? As I said, you always have to compare it so that you know how much cash they have left. You always need to know how much cash they have left because it's gonna make up for all the dilution and so on. That's the most important thing when we talk about dilution. A company is not really likely to dilute hard or dilute really aggressively if they have cash. Just think about it. Companies dilute because they want to have cash, and if they have cash, they won't do it, or they won't do it as aggressively. And what we want are the really clear moves where they really dump a lot. So in this case, we find out their cash burn is 1.1 million, or let's say 1.2 million, but they have 17.8 million cash, which gives them basically right around 11 to 12 months, I believe, or even more, right around 14 months, I think, which tells me, all right, even if we get over 1.5, they won't be that aggressive, or the likelihood for them to be that aggressive is not hard. And they don't really need to push it up. A lot of the stocks with dilution are going to get pushed, basically pushed up by the companies. They hire people to do so. They push the stock over that warrants level, or that offering level, or something else, convertible notes, and so on, pretty aggressively. So they use a lot of capital basically to get over that number, and then they dilute, basically, they dump the warrants, or basically the dilutive instrument. They dump it, and then they sell the shares, they trap people, and so on, so that they make the most cash out of it. But in this case, they don't really need to push it because they don't need to get over that 1.5 mark. This tells me two things now. First of all, if they get over that level, they won't be aggressive, or they will dump, and the price is not really likely to get over 1.5 today, just because they don't need it to get over that. They need it in the long run, but not today, and that's why right now you don't see a lot of volume on it, so on and so on. So the filings tell the story, basically. So after that, we're gonna look at the dilution, basically, just so we can write it down for the next time. We know it's not likely to happen today, but still we want to know it just because the next time we won't do the research. Every single day you do a research on a stock, you won't do it the next time, so you basically are investing your time. So we're going to type in warrants at first, alright? And we're going to look basically for the liquidity tab, or some kind of table. Let's see, here on the common stock, let's see here, going down. So, shoot, 400,000. So they have multiple series. So that's basically you don't have one type of warrants. You're gonna have multiple type of warrants. So series A, B, C, D, and so on and so on. Some companies have even like A, Z, or something else. So they have a ton. And in this case, we've got warrants all the way till series D. We're gonna look at where they are, what they do. So they had an offering in October 2018, and the weighted average is at $1.5, but I want to know exactly, basically, what is going on with them basically. So we issued warrants to the investors and underwriters to purchase an aggregate amount of 10,423,000 shares of the company's common stock at an exercise price of 1.5 and a term of 5 years. Right, so they still have time to dump them. It's not like sometimes you're going to see a term of 1 year, let's say, and the warrants would have been issued in February last year. So in that case, you know, all right, they still need to be paid back because warrants are most of the time given to people you lend money to or products or something else as basically payment. And in this case, it isn't the case, so they still have time to dump those warrants, and so it doesn't really matter to them right now. Let's see, these warrants issued had a relative fair value of 1.8 million and a fair value of 2 million. Alright, so let's see. Now that we know that they have those warrants at an average of 1.5, we're going to try to look exactly when those have been issued, by whom, and so on and so on. The securities offered, blah blah blah, Series C convertible notes. So the Series B are convertible into 8.3 million shares at a conversion price of $1.5. One second. Just clicked it away by accident. 1.5. The ones are useful in 5 years. Alright, so they were able to purchase more or get more of those warrants, and that's what they did, basically. Let's see here, something new. Same thing here, other red flag. Although it is difficult to predict our liquidity requirements based upon our current operating plan, as of the date of this report, we believe that we have sufficient cash to meet our projected operating requirements for fiscal 2019 and through February 2020. Alright? So that's enough for me where at this point I know, alright, I'm not going to be aggressive. Even if it gets over 1.5, we'll need to trap a lot of longs, and I'll basically need to adjust my size. I'm just gonna pull up now that we're done with it. So we're not done completely now on this trigger, but what I want to do now is look at a newer filing. So as I said before, this one was posted, one second, where is it here? Was posted on the 7th. Alright, so let's see. We need to basically look at the other filings. So in the 10Q, you're gonna have basically all the things that happened prior to the date of the release of that form. But sometimes you're gonna have basically a new offering or a new 424B or something else, which gives you basically the right to dilute more. And it won't be in the 10Q, alright? And that's why we want to look at it. And in this case, we don't. So we don't have a newer filing that would give me the idea that they could dump more, and that's basically the last thing that we had to do. I'm just going to check out one more thing, and I want to look at the filing where the warrants came from. In this case, it's the 424B4 from October the 5th. Alright, and we see, alright, 460,000 shares of common stock and 8.8 warrants, and 8.3 million shares of Series C convertible preferred stock. So let's see. Let's go right down here. $1.5, $1.5, and that basically means that we're gonna write exactly that down. So $1.5 warrants for, let's write it that way, 8.8 million and 1.5, then we're going to put the warrants just in front of it. And that's basically it. So that's how I do it every morning. I usually, as you know, do it a bit faster. I'm done within, let's say, 5 to 10 minutes most of the time doing the research. And when I really want to dig into a stock, let's say something like AWX or something, I'm going to do it in a whole other way, really in depth basically. But that's what the next video is going to talk about. Alright, so that's it for AYTU. So I'm going to recap it once more. So AYTU has an 8.5 million float, which means it won't, or it's not likely to spike really big. They have a 25% institutional ownership, which is alright, meaning they are not going to be that aggressive with trying to holding it up. They have 17.8 million cash and a cash burn of 1.1 million, which means, or 1.2 million, which means they have plenty of cash left. They have a current ratio of 4.7 million, which means if they had to pay back every liability they have, it wouldn't be a big problem actually. They have an accumulated deficit of 87 million. That's alright. It's not that big of a number. It's not as big as it seems. A lot of companies have multiple 100 millions accumulated deficit, and in this case, this company is a bit bigger, and 87 is really not that big of a deal. They have warrants at $1.5 for 8.8 million, but they still have a lot of time to dump those, which isn't a big problem for it. Alright, and that's basically it.